Randy, Professor, thank you so much for taking the time. Honestly, for a busy day. I do have, a little bit of a pickle or a bone to pick with you.
All right.
Because you are well known for a lot of your writing and thinking around markets, and you're well known for being a professor here at Harvard Business School. But you're not very well known for your entrepreneurial ventures because you're a bit too humble. And
I doubt that.
and so I have so many questions on the markets, so many questions on AI. But before we begin, I would love for you to give yourself proper credit and talk about the two companies. Well, I guess you could pick two, but the two companies, your largest companies you founded, and share a bit more on that.
Well, there's a few things I'm working on. I teach the Field X and Field Y classes at HBS, which are classes for people who are starting businesses while they're in school. And if you want to teach somebody something, one concern is that if it's too obvious to you, it can be hard to explain things that seem obvious. And so you can imagine being a very, brilliant mathematician, and then you're trying to teach fourth grade math or something, and it just seems so simple. But by helping people start businesses in my life outside HBS, it makes sure that I am constantly aware of the incredible challenges of getting anything started. And so I don't think I ever make the mistake of acting to the students like the difficulties they're facing getting their business started are trivial, and why can't they just solve this? One thing that I've been really excited about is PEO Partners, which is a company that creates liquid private equity. Liquid private equity is an idea. I actually gave a speech at HBS 25 years ago arguing, hey, private equity is the best performing asset class. And that's in terms of not just very high average returns, well above the stock market, but also when the market crashes, PE reports numbers that are not down nearly as much. It's a diversifier. If you have stocks and bonds, you add a third asset class in private equity. It can lower your volatility across your portfolio. So it's very attractive. But most individuals don't have any money invested in private equity, and that's because it's very hard to access. The minimum at most funds is $1 million. So if you want a diversified portfolio of private equity, you need tens of millions just in your private equity, and the private equity is only a fraction of your portfolio. So you kind of have to be crazy rich to invest in private equity if you're not an institutional investor. And then even if you can invest, you have liquidity challenges around PE. I like to say PE is triple illiquid because the usual thing, you put money in, you can't take it out when you want it. Second, at random times when you least expect it, they call you and say, hey, we need you to send us, $372,000 by next Friday. Even people I know with tens of millions of dollars can't just send all that money is accounted for. And then also, just when you think you've got everything exactly the way you want it in your portfolio, they sell something and they send you a check. And you're like, hey, but I actually liked having this money in PE. Can I put it right back to work in PE? They say, no, our next fund closes in March, and then we'll draw down that capital over the subsequent 7 years. And you're like, wait, that's not going to keep me in balance. So it's tough to invest in private equity. Even honestly, big pension funds and foundations and all have trouble. And so by creating something that performs like PE, that tries to take advantage of all the smart stuff PE does by studying PE in depth and really getting the data on what PE does, and then you say, let's create something that invests in public companies, but are maximally like the companies that PE invests in at any given moment. You constantly stay up to date as to what PE does. And that gives you liquid PE, and that helps with these liquidity challenges, and anybody can access it. And so that's been something I've been working on, as I say, intellectually for 25 years and giving speeches around the world. The company started about 5 years ago. We have a mutual fund up in Canada with hundreds of millions of dollars in it, and we're launching products in the United States and globally as well. So that's the thing that's really been the big focus of mine outside of HBS, and it's been amazing experience. And every day we're dealing with entrepreneurial challenges.
Yeah, and that's maybe the accumulation of your life's work, but one of the many firms that you've built, and you're in the game as an entrepreneur.
Yeah, I have a lot of friends, and my friends like to start businesses, and I don't like to be in charge of anything. Yeah. But I have friends who are real, who have that leadership ability that I respect so much, and so I try to help any way I can. Yeah. And of course they have former students who start businesses. They reach out to me after graduation, and sometimes I'm able to help them, and I'm just so thrilled to do it. There's just nothing more exciting than entrepreneurship.
So you're in this unique position. You must talk to hundreds of entrepreneurs a year because with the
that's
rate of field X and field Y, you're opening up your
just in the
scheduling
class
calendar.
we have over 100 teams a year, so absolutely, yeah.
And so talk to me about the difference 2023, 2024, what you're seeing with the building of AI companies versus maybe the last few years.
Obviously it like sounds like a setup question
almost.
for this, but I can promise you that if a person who, had a dirt farm said, what changes are you seeing? I'd say, boy, a lot more teams doing stuff with AI. Like that's just the answer. And in fact, it's interesting because there's along two dimensions. If you compare to even 2 years ago, I would say, the number of teams where they would say our company is an AI company has gone from 0 or approximately 0 to I would guess we'll have let's say this semester we'll have 70 teams probably, and probably I'm going to guess between 15 and 25 would describe themselves as being in the AI business. Now I haven't seen those companies in today's first class, so we'll find out. But I'm going to guess dozen plus. Okay. And then there are all the companies that would not call themselves AI companies, but AI is core to what they do.
Yeah.
And I think you and I may have talked about this before, Brian, but the writer who influenced me most in my teens and 20s, actually his books are sitting over there in the corner, is the baseball writer, Bill James. And he was sort of the first person to really dig deep and do statistical analysis of baseball. And of course, Michael Lewis wrote the book Moneyball about how his research had affected things and so forth. And he's a wonderful writer and thinker, as well as, I love baseball and I love statistics, so he was right up my alley. And he had this wonderful piece about how people used to, people at that time would say he was doing computer analysis of baseball, right? And this is in the 80s. And he was like, I understand why they're saying that, but what you have to understand is this computer thing feels new to folks, but down the road, people aren't going to talk about computer analysis of baseball. He said, if you go read stuff written in 1915 or 1922, people would talk about going on a car trip, right? Because it was special that they were taking a car. But now you just take a trip because, of course, cars are going to be involved in any trip you take, right? And he said in 20, 30 years, all analysis, you're not going to ever say computer analysis because, of course, computers are used in analysis, right? And, of course, he was totally right about that, right? Nobody would talk about computer analysis of baseball now. Well, that's where we are with AI, right? It's just going to be the case that right now it's like if you're doing something with shoes and it's like AI involved, that's a thing that it's AI involved. But in 30 years, there will not be a shoe company on earth that isn't using AI.
Right.
Like, of course it's going to be there. It's just going to be natural. So that's the phase we're at, is that we've got 10, 20, 25% of the companies where they are AI companies, and then another 30, 50, 70% of the companies where AI is super important in what they're doing, even though what they're doing is shoes or accounting or something else.
Yeah. And you're in this interesting spot. You see both the birth of dozens of AI companies at the very cutting edge, but you're also spending a lot of your time thinking about capital allocation and fund managers. So you look at the earliest inception and then the capital markets. And so do you think that there's a disconnect between what a lot of the fund managers or a lot of the capital markets are expecting or seeing across what's going to happen in AI?
Well, so of course it's funny, there's two big issues with capital markets and AI, right? One is, are the fund managers using AI the right way? And so let's talk about that for a minute before we talk about the broader guy. And that's super interesting because what's funny is, so I had this amazing conversation once with a big hedge fund guy, like very, very successful. And he was complaining about these ridiculous rich hedge fund managers with their 200-foot yachts, and how the yacht is so expensive, it's so huge, the crew costs so much gas, you take it out for a day, you're spending tens of thousands of dollars on fuel, and then you can't even bring it into shore to get off. You need a smaller boat attached to the boat that you can take into shore, and what a nightmare it is. And then he said, now my yacht is 70 feet, and that is fantastic. And then he talks about the wonders of his 70-foot yacht. And so I sometimes joke that I have a view of life, which is try not to be 70-foot yacht guy, right? In other words, if you want to be super well-dressed, that's amazing. If you want to wear t-shirt and flip-flops, totally amazing. But And if you want to wear, I don't know, polo shirt and chinos and be in the middle, that's fine too. But don't be the person in the middle who then says, if you dress fancier than me, you're some kind of, superficial, obsessed person. But if you're sloppier than me, then you're a lame slop, right? In other words, don't try to. Okay, well, this is where I think a lot of people in asset management have been, is that you'll talk to quant managers, and if somebody is doing sort of old-fashioned fundamental analysis, they'll mock that, right, and say, oh, that's so unsophisticated, right? They think they can watch a guy on TV and say, oh, I saw the glint in his blue eyes, I like the cut of his jib, I'm investing in that guy. They think that's ridiculous. But then when you ask them about AI, they would say, oh no, that's all propeller head nonsense, right? They think they found the perfect sweet spot. That is where the conversation has been over the last decade. I think the last 2 years, less and less of that. I think everybody's starting to understand they better start incorporating these tools. Now, there's still plenty of skepticism about large language models, right? So in other words, sometimes they'll use the term machine learning or autonomous learning to separate what we might call old school AI, right, which is sort of very fancy ways of running regressions, from the new large language models. I think there is emerging evidence that large language models have something to offer in terms of beating the market. But I have very smart friends who say, well, what they have to offer right now is they're really good at codifying the conventional wisdom that you can make money betting against, right? So if you ask ChatGPT to tell you about what companies look promising because of earnings, they'll say the CNBC thing that is going to be wrong, that's going to be that's pushed you. So I have friends who argue that, but there's some new research that says no. If you actually follow what it says about companies, I'm not saying literally like ask it to pick stocks for you, but if you say to it, what are companies where the highest earnings growth should be expected or something like that, that there are ways to make money on that. So lots to think about on that subject. But now let's just turn to the broader markets and sort of say, okay, what's going on with AI and investing? So here's how I think of it. There's a set of stages of questions of should we all be making lots of money betting on AI in the markets, right? Okay, so the first question is it overhyped or is it for real? Okay, and I would say if I ask my 20 smartest friends, you'll get it's somewhere between 40-60 and 60-40 on this question, right? There are people who say, oh yeah, they told us that crypto was going to be running the world by now, or they told us and they'll list previous overhyped things that turned out to not be so important. And then there's other people who say this is a huge deal. I am a huge deal person. Okay, my sort of serious, slightly jokey but kind of serious thought is, I think the fundamental question about AI is it the biggest innovation since electricity, or is it the biggest innovation since fire? Right? Like, I think it's going to be more impactful. I mean, obviously, to the extent that you need electricity and computers to have AI, you can say, what does it mean for one to be more impactful? But I think the AI revolution, like 30 years from now, we're going to look back and say, AI changed things more over 30 years than computers changed things over 30 years since computers hit, right? I think it's going to be more shockingly extraordinary in its impact. So, but not everybody agrees, okay? So it could be that it's overhyped. Okay, so that's first. And obviously, we saw with we should always remember this. If you think about Web 1.0, the 1999 tech boom or tech bubble or whatever you want to call it, it was both a massive game changer for society and an overhyped bubble. So you could have both, right? You could have both, okay? And I would say, I see an article, just perusing Apple News, Google News, whatever. I see an article arguing, the market is finally realizing that, AI is an overhyped bubble and it needs to crash. I would say, what do you think, twice a day? 3 times a day? Between 2 and 3 times a day. I mean, it's ridiculous. So that's question one. All right, let's suppose we say, no, it's for real. Okay, so now question two is it going to enable companies in the sort of short to medium run to make more money, right? And because obviously one way to bet on AI would just be to say, bet on the market to go up, right? Or bet on the tech part of the market or something. Okay, and so is it going to make, will companies make more money? And there's a pretty good argument that they will, right? They have experience, they ran an experiment last summer, so using, so this is a year-old version of AI, right? Not now, and certainly not what's going to be a year from now, but 23, and they gave young attorneys a task to do, various tasks that were typical young attorney tasks, reviewing contracts and other things of this nature. And half of them, they had to do it with ChatGPT's assistance and half without. And the half with were sort of 25% faster and sort of 5% better, right? So they did a little better in way less time, right? So now you think, my gosh, if you've got a company and you can get your employees to work, 30% more efficiently, you're going to make a crazy fortune, right? Because now you saved all these costs, and margins are thin in most businesses, right? So you say, gosh, we had an 8% profit margin. Now we cut our costs, at least our labor costs, which is half our cost, by 30%. That's a 15% cost. Oh my God, we're making 23% instead of 8. I probably did that math a little wrong, but you get the idea. There's compounding and stuff. But okay, so that is pretty sensible. Okay, but then if you accept, all right, fine, this is going to cause, and by the way, there's skeptics on that too. I know plenty of people are like, oh, this stuff won't work. People are just, they'll write 10 times as many emails because the AI writes the email faster for them, and then who's going to read all those? So it's not obvious it's going to be better, but I think it's going to be better, and there's a good case. So let's say it is. Well, then though, you get to the next step, which is competitive forces, right? Sure, my company is going to, need 30% less workforce to do the same amount of work. But you know what? All my competitors are going to discover the same thing.
Yeah.
And so then there's going to be price competition, and then the margins might just go down right to where they were. Now, somebody's going to benefit, right? Maybe it's the supplier that the people we supply, but maybe it is consumers in the end. Okay, so it's not to say there's no benefit to the world, but it doesn't necessarily increase corporate profits, right? Our corporate profits way higher because the internet made people more efficient in certain ways, but it doesn't necessarily make corporate profits higher. Okay, so that's 3. All right, and then, but let's suppose you think, no, it will though. It will make profits higher, even with competitive forces, blah, blah, blah. You do that analysis, right? You still have question 4. Has the market already priced it in?
Right.
And this is always the question in any, my advisor in graduate school, my PhD was Eugene Fama, who developed the efficient market hypothesis. And he said, look, if Brian knows about it and Randy knows about it, well, there's plenty of other people who know about it because we're not unique. And if they all know about it, then why isn't it there in prices? And by the way, if you look at what happened with the markets, it's kind of crazy, right? If you go back to sort of late 22, the interest rate, do I have my date right? Late 20, I think it's late 22. The real rate of interest, maybe I have to go a little earlier. The real rate of interest is, it's like around 0.
Yeah,
in fact, it's actually I think it's November 22 if I have my dates right. That the 30-year TIPS, the Treasury, the inflation protected bond, paid negative 0.5%.
Yeah.
So you get negative 0.5 plus inflation. Okay, and that number is now 2. Is now plus 2, maybe a little higher, right? So it moved 2.5%. So if you had a very long-term bond, like Austria had a 100-year bond that they issued around that time, that bond is down 75%. Because interest rates moved so much, okay? And Austria's not at any risk. That's a riskless bond. They're going to pay, right? But it's still 75% lower. So the stock market has a duration similar to a 100-year bond. So you might expect that the stock market should also be down 75% if nothing had happened in terms of good or bad news for the economy. Now, if you ask the man on the street, I was like, oh, the economy's 10 times worse. It's got to be higher. That's debatable. We've had some inflation. If you fiddle with the numbers, what you get is the market should, if there wasn't any good future news, just the stuff that's happened, probably the market should be down between 1/4 and 1/2. If you put how much, just general GDP growth and inflation and so forth, plus the hit from the interest rates, probably the market should be down between. Instead, it's up, 50% or something like that. So then you say, well, maybe they did price that AI stuff. And I'll tell you, the first time I used GPT-3, I called everybody I knew and I said, guys, are we sure the market shouldn't have doubled yesterday?
Yeah.
Because it really is not crazy that GDP might grow like 1% a year faster. And if that's true, then, boy, when you do the Gordon growth formula, which is dividend over R minus G, and you add 1 to G, it is unbelievable what it does.
You start to project that forward in the Excel sheet.
It has a really, a small denominator, gets smaller. It's a big impact. And so just one other thing I want to add in terms of this, thinking about total value to society, is innovation, right? In other words, if the innovators, if the scientists and engineers and technologists are able to work faster, the people I know who write code for a living, well, I mean, you can tell me about you guys, maybe I'll throw it back on you, but the people I know tell me, they're like 3 times faster than they were 3 years ago because of these co-pilots and so forth. And if people are writing code 3 times faster, and that's, again, that was last year's version. I don't even know about this year's version, and the version 5 years from now. And so you start to think about the hardest problems and the most important problems society faces. Getting nuclear fusion to work, doing desalinization cheaply. So many of the fights in the world are over water. What if you could do desalinization at almost 0 cost? Space travel. If you start to make geothermal fracking, right, that would get us carbon-free energy at low cost. if we start to solve those problems, if we have problems that we thought we were going to solve in 30 to 50 years and we solve them in 10 to 15, oh my God, right? I mean, the sky's the limit.
Yeah.
So a lot to think about.
Yeah, I'm obsessed with this idea of adding leverage towards productivity, not financial leverage like technology leverage to productivity. And if you think about the greatest lever of productivity pre-AI, it was software. And so that's been our great enabler. And if we think about a world where, and software is extremely hard to build regardless, even with copilots, it involves lots of people. You have a company with lots of software developers in it. And if we think about a world where the cost to deliver software goes down by 100x, which I think is the world that we're approaching over the next few years. And we think about the leverage that software can then provide to those companies. We are levering up the greatest economic technology progress that we've ever had, right, in our lifetime by 100x, right? And so how does that matriculate into companies? Like, what does that mean for the margin of companies? Like, it's almost hard to grasp because you're adding an exponential towards an exponential.
Yeah.
Like,
no, exactly. It's I guess the people who really have been thinking about these kinds of issues for a long time are the people who do like growth theory and all, economists and other scientists who try, and they ask themselves the question, what are the bottlenecks?
Yeah.
Right? And I don't have a good sense of this, right? So if the bottleneck was people who are smart enough to write great software and who also choose to take jobs writing software. And so creating amazing software, there's that old Steve Jobs line about how like the best software person is 100 times, I'm sure I don't have the quote right, but best software is 100 times better than, the 90th percentile person, and in accounting they're only twice as good. Now I think he chose a bad example in accounting because superb accounting can make and make a very big difference in a corporation as well. But it's certainly true that there are many jobs where the best person versus the very good but not the best person is a factor of 1.5 or 2.
Right.
And then there are certain jobs where it might be a factor of 10 or 100 or 1,000. And so probably that's been a bottleneck to a lot of amazing things we'd all like to have. And if software development gets a zillion times faster because either the people are able to do it much faster or the machines are doing it themselves, or people who were only good enough to write okay software become fantastic software writers with the help of the machine, then it's one possibility is 10% annual growth, or the kinds of numbers that lead to just staggering things happen. More likely is we discover bottlenecks somewhere else. Now, where will they be? Well, some people say, energy's going to be the bottlenecks. The AI suck up lots of energy. I'm not convinced of that because I believe that we've already come a long way with energy, and again, I think if we can write software, we're going to have breakthroughs that enable us to have more energy cheaper. The whole too cheap to meter concept on energy, which I'm a huge fan of. And then, but that doesn't mean there's not something. That's maybe it's raw materials for the chips.
Right.
Maybe it is the ability of It's easy to say, well, gee, if you had this software, you could create these products at 1/10 the cost. But you actually do. There are all these steps in between, and the question is, what are the blockers to those steps, to the things we want to create? And I guess a lot depends on what we're going to want when we as a society are a lot richer. If what everybody wants is grand mahogany desks, well, like growing mahogany takes time, right? That's not going to be something that's going to happen overnight. But if what people want is a video game so immersive and convincing that you feel like you're having the most exciting, wonderful day of your life, that may be something that we can deliver shockingly well, shockingly fast.
There's this theory or paradox that the demand for software is completely elastic to the ability to supply it. And so there's a thinking that like software will almost inevitably always be the bottleneck because the need for organizations to automate things that otherwise are driven by human is near infinite, right? And so we are entering a moment where the market size for these companies is no longer attacking the traditional, like, oh, this is how big the software market is. Like, we are now having software move into the labor market because it's doing jobs to be done that were otherwise only possible by humans. And so, like, do you think that the equity markets are appreciating the fact that, like, the market size of the opportunity has actually expanded quite dramatically?
it's hard to say. I'm not going to pretend I've done that analysis. What I'll say is that it feels like what the equity markets have done in a sense is to say, it's too hard to figure out who the winners are going to be on this, except we know NVIDIA is going to be a winner.
Yeah,
we know people are going to want these chips, right? And to the extent that other companies have shown that they might be able to make chips that are at least somewhat competitive, right? Even if they're only half as fast or whatever, they'll still be useful.
Yeah.
Okay, we'll do that, and so it's kind of like an extreme version of the picks and shovels thing. People are like, I just have no idea where the gold is.
All the way down to the base layer.
I have no idea where the gold is, but if there's a bunch of guys who are willing to go out and look for, I'm confident that selling them blue jeans is going to be a moneymaker, so we'll do nothing but that, and I mean, the old thing was, boy, people forget about the picks and shovels and forget that Levi Strauss is, the only guy whose business is, still giant all these years later or whatever from the gold rush. But it's but it almost, you almost wonder if we've overlearned the lesson. But I do get it because, I'm not going to pretend I could figure out which companies are going to have the AI breakthroughs that are really game changing. I mean, you look at OpenAI and it seems like, well, they're so incredible, the product is so great, and people are going to want it so much. But then, I don't know, I think 8 guys left OpenAI and started as a Perplexity, and then 10 months later they had to, or no, it's the other one, right? The one that does Claude, right?
Left in the Claude.
And 10 months later they had something that is somewhere between 90 and 105% as good as ChatGPT. And so then you're kind of maybe that's not where the money is.
Right.
Maybe that's something, because, there's certain applications for which having the one that is 5% better than the second best, if you're using your AI for trading stocks, then being 5% better might be worth $1 trillion a year, right? But for most consumer applications, who cares if one is a tiny bit? In other words, if there's a free one and then there's a 5% better one that costs $50 a month, people will take the free one,
100%,
right? And so where the divide is between the people who will pay up and not. So even with something as amazing as OpenAI, I can totally understand the argument that says that's going to be a commodity business. Any kid with a laptop is going to be able to come up with something 2/3 as good in a year. And I'm not saying that's true.
Right.
I'm just saying I get the argument. It's a possibility.
Yeah, if value is future cash flows discounted to the present, right, with some probabilities assigned to those things. The question is, how good are we assigning the probabilities and assessing the cash flows? And you have done some really interesting writing around cash flow reactions between institutions and between individuals. And we've seen markets generate new cash flows of companies like Meta on orders that are surprising. And so I would love to hear your perspective on the reactions to the change in cash flows that we've already seen.
Yeah, well, the general history is that institutions are the smart money and individual investors not so much, And
Tough news for them.
I wish I could just be a contrarian on this, but it just doesn't. It does seem like, unfortunately, kind of what you might think of as the conventional view that people who spend all day, every day, trying to maximize profits and getting fired if they don't, turns out to be a better incentive scheme. I have this joke about being a sort of a stock picker, mutual fund manager, whatever, which is here's how the whole thing's set up is. We take a group of people and then we give them superb training at places like Harvard Business School, right? Couldn't be more wonderful. And then we say, and these are incredibly talented people to start with, right? So first we're going to cherry pick the most talented people. We're not going to let anybody else into these elite institutions. Then we're going to give them unbelievably good training. And then here's the incentive system we're going to set up. We've created this video game called Beat the Market, right? Pick stocks. And if you are good at playing this video game, we will pay you 7 or 8 figures a year for doing that job, for playing a video game all day, right? And if you're bad at it, we're gonna, fire you and you'll have to be a management consultant or something, right? Now that's what we call a strong incentive structure, right? So now you've taken and here's what's funny, right? Is I put to you that never in the history of the world prior to this has anyone ever claimed that you're going to take unbelievably talented people, give them superb training and incredibly strong incentives to succeed and get results worse than a monkey throwing at a dartboard, right? But that is what people say about stock pickers, right? Now, I don't think that's really true. I think that if you look at the evidence carefully, what you find is it's true that the typical mutual fund doesn't beat the market, but that is because after fees and trading costs, they don't beat the market. I think their stock picking does beat the market, and then they Wall Street sucks it out through fees and trading costs.
Perfectly efficient, by the way. Yeah.
Exactly. And this is what's known as Grossman-Stiglitz efficiency after Joe Stiglitz, who's a Nobel laureate economist, and Sandy Grossman, who would have won a Nobel if he'd stayed in the profession. Instead, he went out and made gazillion dollars running a hedge fund, incredibly successful hedge fund. And exactly, so it is a form of sort of extended form of efficiency. My guess is we'll see the same kinds of differentiation in terms of who gets it right. I just saw that Cliff Asness, who I went to grad school with, who runs AQR Capital, enormous hedge fund, just put out a piece claiming that the stock market is less informationally efficient than it used to be because of essentially social media affecting individual investors to where, obviously as an extreme, think of GameStop,
right.
And a bunch of people can come in and push prices out of line and so forth. I have other smart friends who are skeptical of Cliff's thesis and don't think things are less efficient than they used to be, but Cliff's a very smart guy. I haven't read the paper yet, but I'm sure he makes a strong case. So it's and obviously the places where you would most expect to see wacky stuff happen is in anything that is anything that appeals to individual investors, so consumer oriented, and B, anything related to cutting edge technology where it's so hard to figure out what's going on. So I think AI stuff. There's going to be some strange trading, and there will probably be opportunities. But I remember when GameStop first blew up to a super high price, went up 10x or something, and I was like, if I weren't so lazy, I'd short it. And then it went up like another 5x before it hit the peak. And so it was just as well that I was lazy.
Yeah, sometimes the best decision as an investment professional is to do nothing, and that's sort of the hardest thing to do sometimes.
It is. It's hard. It is hard, and obviously, you can miss out on stuff. So these are hard problems. Now, look, if you're a professional and you're in the markets every day and you look at 100 opportunities a day, you're not going to swing at every pitch. You're going to pick some of those that you really like. But as a person who's sort of living their life, and then every once in a while something pops across your radar, and you're like, well, should I be trying to make money off this? It's a hard game to play, but obviously there are people who've been successful.
Yeah, I think why I appreciate capital allocators is you have to express your opinion, with resources, and we know how you're doing that in the public markets. So the closing question I would ask you is, you also angel invest a bunch, you invest in a lot of companies. What do you see in these AI companies that actually makes you say, wow, I have to be involved in something like this?
Yeah, it's a great question because so let me say that the thing that is the hard thing, which is people will have a great idea and you can see that there's a market for the product and you can see they're capable of building the product. And the question is, by the time they're out in the market and have told the world about it and people have an opportunity to buy their product, will the baseline, free or near free, offerings from ChatGPT and their competitors just do this,
right?
And that is a really tough problem. So what you're looking for is an idea that not only is something people would want, which again, tons of those are out there, and that the person is capable of doing, which again, with such gifted students, we see that a lot, but something where you can honestly convince yourself, this isn't just going to be available free. And by the way, we've seen this across the software where people would come up with these great ideas and then, Excel just adds it as a feature. And you're like, shoot. Now, shockingly often, Microsoft buys the company instead of just copying the feature and adding it, and there wasn't a patent or anything, and you're like, wow, that person got $100 million for that idea, which Microsoft could have just paid 2 guys for 3 weeks to create. Good for them to get their $100 million, and sometimes it's clear that those payments are right. I remember being surprised when Google paid $600 million to buy YouTube, where I guess will be people are watching us right now if they're hearing my voice, because Google had already created their copy, Google Video, which seemed pretty much identical to me as a consumer. But now YouTube's worth like $600 billion instead of $600 million.
What a move.
And I don't think Google has any regrets that they paid a little bit, what seemed like a lot at the time, but was in retrospect a little bit, to buy YouTube. So, that's what I would ask oneself is, A, is this just going to, by happenstance, in other words, are they just going to create something so powerful that it does your thing without they weren't even trying to add you as a feature?
Right.
It's just their thing does so much that your thing is one of the things it can do. And then second is, if not that, are they going to say, oh, that's a really good idea, we should add that? And then if not that, then okay, will you be able to stay in the market selling, or is it possible one of the big firms will buy you out? And is that a good exit for you? Which it might be. But so searching for the ones that kind of fit that criteria, that set of criteria is it's a lot to ask. But on the other hand, the upside is so enormous if people get things right, because just imagine somebody can create something that is really good at giving tax advice, right? And let's say that it's really good at giving tax advice, and it's not going to be the case that ChatGPT is just going to give you great tax advice because so much stuff is read into it that it just does that without even trying, so to speak, right? Well, I mean, the value of that is billions, trillions, gazillions, right? I mean, it's crazy.
You tack on distribution of an existing player, of course they're going to buy it and amplify the value, and so it makes sense. Cool. Well, thank you so much, Randy. This has been an absolute pleasure.
Always great to talk to you, Brandon.
I appreciate it.
Cheers.